Sunil Subramaniam joins us, Managing Director and CEO of Sundaram Mutual Fund. Sunil, long time. How you been?
How you been?
Markets have made a roaring comeback, Sunil. Now, on a global front, news has deteriorated. On the liquidity front, FIs have turned net sellers. But if one looks at the market strength purely based on price, for the small cap, mid cap, and the large cap, the strength is quite amazing. So what is causing this constructive price action in the market? I'm not complaining, but I'm curious to understand.
I think it's the SIP book flow. So if you see, it's almost touched 20,000 crores, and my analysis shows that more than half of it is in small and mid cap funds. So what's happening is that these funds are getting buying power every month, and what happens is that the liquidity, the difference between large caps, mid caps, and small caps and liquidity is well known. But what is also very clear is that even within the small cap pack, which is stock number 251 and below, there's a huge drop off on liquidity as you go down the cap curve. So what happens is that fund managers obviously have a filter for quality as in growth prospects, right? So those companies are naturally getting higher in allocations and valuations, and the lack of free float means that the prices are rising quite high. And FI action is absent from that segment because FI action is largely limited to the top 100, 150 stocks in the country. So when FI sells, right, there are some fund managers maybe in a flexi cap who would try to reallocate his portfolio and buy some of those large caps coming cheap. But that's only at the top. And there the price actions don't move so much because free float is very high. So it's entirely a story of the concentrated domestic liquidity in the small cap and mid cap space combined with the low free float means that the correction which happened because of the froth kind of statement from SEBI and that followed through gave a good buying opportunity because cash is going on coming at the counters. So I think SEBI's efforts to make the mutual fund industries bring down the SIP flows or bring down the small cap fund flows haven't really impacted much because SIPs monthly, nobody is stopped, right? I mean, they've limited it to 25,000 rupees in some case, but the mass market SIPs are still coming into small cap and mid cap. And those flows are coming in, and the industry has done a little bit of a rejig in Feb March when this frothing happened in terms of shifting some portfolios. So some of the selling, the correction that happened was caused by mutual funds booking profits in some of those markets which have gone up. Now the fresh inflows coming in with the price correction again makes them a good entry point to buy. So I think this is a trend which will sustain for some time because SIPs don't get stopped. And even the recent correction did not mean that your 1 year SIP or something got hurt in terms of value. So people are not going and prematurely closing an SIP because of a temporary volatility. There is some maturity in the domestic investor too happening.
Right. Okay, Sunil, stay with us. Lots more to talk about. But I'm going to quickly take it across to Ansh and find out what's really buzzing in this market as well. Ansh?
Yes, so BSE is the first stock which is buzzing a lot today. The stock has given a breakout from its 12th session consolidation pattern, surpassing about that 3,000 mark for the very first time with volume of over 3 times its 10-session average volume. The stock has also been advancing for 4th consecutive session. Apart from this, we also have Sobha. The stock seems to have given a breakout from its cup and handle chart pattern with good volume of over 2.8 times its 10-session average volume, and the stock has also touched record high level today. Lastly, we have Tata Teleservices. The stock has actually given a breakout from its double bottom chart pattern with volume of over 18 times its average volume of last 10 sessions, showing very strong participation in today's breakout. Also, the stock has surpassed about its 50 DMA level. So for those reasons, the stock is in focus.
A bit of stocks out there. We've discussed BSE, there's Tata Teleservices as well, which is holding out. Kunal, just as to what is it that you pick out, Bharti or Idea? I mean, I know Idea FPO is already done with, but what's looking like the stronger telecom chart?
Well, of course, the strongest one is Bharti Airtel, without any doubt, because the stock has managed to withstand a lot of volatility. And I'm not talking about the last couple of months, but over the last 3 or 4 years as well, that stock has managed to stand up quite well for itself. There was a zone around the 550 odd mark for Bharti Airtel where the stock consolidated for I think 2 or 3 years. But post the breakout for the stock, it's not looked behind, and then it's moved on, on a very gradual, steady kind of a manner. So on the other hand, Vodafone Idea, absolutely volatile. The stock on the short-term charts, on the medium-term as well as on the long-term charts, has been gyrating with a margin of I think 30 to 40% as well. at many points of time. So it all depends on the risk appetite of each individual investor or trader. I would believe sturdy in terms of the sturdiness. Bharti Airtel, of course, is one of the stronger one. But in terms of a potential breakout, say from a short-term trading play, Vodafone Idea has given that breakout about 13.75 mark, which means potentially we could be looking at 15 to 15.5 as a near-term target.
Okay, that's Vodafone Idea and Bharti in trade for you, buzzing very smartly, and a lot of numbers as well, which are due for this week alone. Today, of course, you've got Tata Consumer, which is slated to come out with its numbers. Tomorrow is a very important earnings day. You've got Axis Bank, you've got Unilever, and then, of course, LTI Mindtree. But Sunil, so far, there's been the IT sector, there's been Reliance, and there's been HDFC Bank. The large caps haven't done all that well when it comes to earnings. Any particular pocket where you think there is scope for outperformance in this market?
I think consumer discretionary is where I think there should be some scope for performance, because it's not been performing for quite some time, and I think it's finally it should start showing numbers, I suspect. And not only from a earnings perspective, the guidance for the next quarter also from consumer discretionary, I expect those numbers to come out positive. So I'm a bit expectant on the consumer discretionary front. And this is a broader basket of consumer durables, auto, as well as housing.
There's Maruti as well, which is slated to come out with its numbers this week on 26th. And Maruti is already at a record high, by the way, ahead of its numbers. Let's just bring up that intraday graph because it's back above that 13,000 rupee per share mark. There you go. Almost a 2% bump up on that stock. But what's happening across dealing rooms? Let me take it across to Sharad. Sharad, hi, afternoon. What's the chatter like?
Well, yes, in the dealer buzz, the stock in focus is Zomato, as the HNI counters has been seeing a bit of selling happening across various dealers, as we have been speaking about. Now, this is the biggest intraday fall seen in the stock over the last 4 months itself, and the dealers suggest that there is a profit booking happening across certain segments in the HNI space. Also, roughly 29 lakh shares have exchanged hands in 2 large trades also today, which translates it into 0.03% equity. And importantly, in the month of March itself, last month, Antfin had sold almost 2% stake in the company and actually getting its stake down below the 5% mark. Importantly, the Zomato was in news because of increasing its platform fee hike from 4 rupees to 5 rupees in the key areas, and analysts had expected an increase of almost 85 to 90 crores in the EBITDA as well. But looking at the stock's trajectory, that is up almost 3 times over the last 12 months. So we are seeing some profit booking in the HNI counters.
That's where the stock price is. Today, of course, it's seeing a meaningful dip, that of about 3% as we speak right now. By the way, in terms of earnings, like we just highlighted, tomorrow, of course, is a very crucial earnings day. If we can just get in Vinny to tell us what to anticipate from Tata Consumer as well. It's due to report its numbers. In fact, Vinny, tell us what your poll is penciling in.
So this time around from Tata Consumers numbers, we are expecting a revenue growth of around 9 to 10% better than other FMCG companies in terms of a growth. We are expecting the profits to see a slight bit of a increase of around 3 to 4%. Let's keep an eye out on that in terms of the profits. While margins are expected to see an expansion of 100 basis points, tea inflation that has come down. So yes, we are keeping an eye out on that. But commentary is going to be key for the next few quarters because we have seen again inflation rising back, whether in cocoa prices, coffee prices, tea prices, a bit of a volatility there. So what is going to be the outlook going forward in terms of raw material cost as well as margins are key factors to watch out for. Food and beverages expected to do, or food business is expected to do better. So a high, double-digit growth is what we could say one could expect from food business. While in terms of the beverage business, we're expecting a high single-digit growth. Food business obviously is going to be led by Sampann growth, while overall we're keeping an eye out on Capital Food, the acquisition, the update on that front, as well as Organic India's update coming in. When does that Organic India's numbers start coming in the balance sheet of Tata Consumers? Other than that, let's watch out for market share trends in terms of tea. So these are the key factors that we're keeping an eye out on from Tata Consumers.
Okay, that's about Tata Consumers. We'll come back to you, Vinny, for HUL. But in the meantime, take a look at the markets. It's fallen a bit. It's not a whole lot, but from the highs of the day, we have definitely given up for Nifty as well as Bank Nifty. So in the last few minutes, there has been that incremental pressure that has come in. And remember this after the fact that the Nifty small cap index just managed to hit that all-time high level yet again. From there, I think there has been a bit of a slip in the market. But the small cap index actually is holding up. It's, I think, only the Nifty and the frontline stock which is coming a bit under pressure. We'll analyze that a bit more with the technical experts. But before that, Vinny, tell us about HUL as well. What's the expectation from the giant?
Yes, so this time around from the FMCG major HUL, we are expecting a muted growth in terms of revenue, around 0.6% growth, while in terms of the profit, we are expecting a slight bit of a decline. Margins, so operating performance is also expected to be muted. EBITDA margins expected to see a bit of a contraction around 30 basis points. You could say 23% is what we're expecting EBITDA margins as versus 23.3% last year. Volume growth expected to be muted at 2 to 3%. Low single-digit growth is expected from the company this time around because rural slowdown, that's still there. We're not seeing a sharp recovery. Other than that, increased competitive intensity from regional players, which we've seen in the last few quarters, those demand trends, that's similar. So last couple of quarters, the trends that we've seen, we're expecting similar trends to continue. Now, what will be interesting to watch out for is that the subdued growth in home and personal care segment, how is that there? Commentary on that food and refreshment segment, that's also expected to be muted. And other than that, on the margins, we'll be seeing an impact of the royalty increase that's there, as well as in terms of the impact due to the expiration of the GSK consignment arrangement. So because of that, we are seeing that income is reducing, so maybe some bit of an impact in terms of the margins. Let's keep an eye out on important commentary that could come in from the health food drink segment. How is that shaping up? Because we've seen a lot of issues in the overall sector as in health food drink segment because of the sugar content. What is the commentary coming in from HUL on that front? Right now, there was no issue on their front, but yes, what is the commentary there is key to watch out for. Commentary on competition, regional players, rural demand, and outlook for margins and raw material cost is a key factor that we're keeping an eye out on.
Okay, that's the assumption coming in from what to expect from Unilever when it will declare its numbers tomorrow. But just wanted to understand, Sunil, what your sense is in the market. You've, of course, given us your overall thought, but where is it that you still find pockets of value and undervalue in this market, although a lot of it already looks toppish?
To me, I think the banking segment has suffered a bit, which is I don't think is entirely justified because the future for banks I see as very good. So overall, the BFSI space, I would say, because I think the one thing that you can take that with the manufacturing cycle from the private sector getting delayed, and that's where bank lending probably, while it's growing at healthy double digit, it's probably not growing even faster. But moment that capex cycle kicks in, and you see that happening when consumer discretionary numbers coming in and the capacity utilization goes up, I see that the bank's scope to lend to the corporate segment will have a very positive impact on their NIMs. So you have to take a slightly longer term view. Maybe in the next 3-6 months, they may not go anywhere, but I would still place my bets on the BFSI space, banks, good quality NBFCs, and on the other side, including insurance and asset management and wealth management firms. I see that growing India, that's the one piece which has probably not reflected the future potential fully in the current prices. So, in a relative terms, the pockets of value I would see is there. Second is, for me, again, go back to the consumer discretionary, because those numbers have disappointed, market hasn't really supported those with rise in valuation. So, as those numbers improve, I would expect some amount of growth in EPS to come better than expectations, and hence that would turn out to be some kind of a slight value there to capture.
Okay, point taken. But you did hint about manufacturing, right? Talk to me about what you make of the stock market, stocks with respect to the manufacturing and the defense theme, because they had run up quite a bit as well. And today, of course, shipyard companies are doing quite well. What's the take on defense and manufacturing as a theme?
I think that a lot of the good news is in the price. I think it's pretty much an open story today. There is no surprises there. So to that extent that I would say that the growth for the next year and a half is kind of factored in today. So if you have a longer term perspective of, let's say, 5 years, I would say picking good quality manufacturing companies will deliver wealth creation. But the fact is that these are companies which are highly, cyclical, operationally and financially leveraged. So what happens is that market has projected a certain cyclical recovery in their EPS growth and has factored that in. Now, the only worrisome factor there is that domestic private sector capacity expansion has not picked up speed at the way it was expected to, because the capacity utilization in the country has got stuck at the 75-76 level. When that makes a decisive breakout to 80% plus, which has happened the previous time, it happened in the late 2010 kind of a period, you will see that the private sector capacity expansion shooting up will then the winners really will rake it in. The point is that today it's very hard to predict that winner. So the market has spread itself across all the infra-related stock picks. So if you have a good quality stock picking and are able to read that future growth well, there is still value there. But like I said, you have to have at least a 3 to 5 year minimum view around the infra defense pack, number one. And number two, you got to hedge your bets across 2-3 players and not bet all on 1 or 2 players winning it, because when it comes to a bidding cycle and order books, right, people will tend to undercut and bid and win it. So I think that's a good play. And the other good way to play that is through corporate banks, right? The manufacturing, because ultimately bank financing is going to be 70% of the funding. Only about 25 to 30% will come in through equity. The balance has to be lenders, and banks are going to take the lead there. So I would play the whole infra defense story through corporate banks on the one side and through a diversified pick of EPC contractors and all of that. And generally building materials, I would say cement, steel, and all of that should form part of your portfolio. So having a good diversified portfolio within the infra capital backs is important. And second, having a slightly longer term, don't expect massive wealth creation to happen in the next few months, years. Give it a bit more space and time, because like you mentioned, valuations have run up quite rapidly in that space.
Yeah, they sure have. Sunil, always good to have you on the show. Thanks for taking the time out.
If you like this video, then like, share and subscribe to ET Now.